How did a local South African brewer, shaped by the turbulence of apartheid and the isolation of sanctions, became a global powerhouse, only to be swallowed in the largest beer deal in history? This episode will cover the history of the most valuable company in Africa. In the dusty streets of Johannesburg in the late 1880s, fortune seekers arrived daily with pickaxes and dreams of gold. While thousands dug deep into the earth searching for precious metal, one man saw opportunity in something far simpler. Charles Glass, a former brewer for British troops in India, had just moved to South Africa. He recognized that miners worked hard, sweated harder, and at the end of each grueling day, they wanted nothing more than a cold drink to wash away the dust and fatigue. So, Glass, relying on his expertise, began to sell beer to these exhausted workers, and his castle brewery quickly became their refuge. Around the same time, a sailor named Frederick Mead, with solid financial backing, established the Natal Brewery Syndicate and saw the same potential. In 1892, Mead purchased Castle Brewery from Glass and began expanding the operation. By 1895, these combined efforts led to the formation of the South African Breweries Limited. That same year, Castle Lager rolled off the production line from a newly commissioned brewery with a capacity of 50,000 barrels per year, and the miners loved it. Word spread quickly through the gold mines, and Castle Lager became the drink of choice for South Africa's hardest workers. Within 2 years, the South African breweries achieved something no industrial company had done before. It became the first of its kind to be listed on the Johannesburg Stock Exchange, and 1 year later, in 1898, it joined the prestigious London Stock Exchange. These listings provided SAB with crucial access to investor capital that would fuel its next phase of growth. By 1901, the company made an annual profit of £100,000. In today's money, that's more than $19 million. But as always, success brought unexpected challenges. On October 1899, the Anglo-Boer War erupted, and Johannesburg residents fled the city. The Castle Brewery was forced to close for nearly a year, threatening everything Glass and Mead had built. But even in crisis, opportunities emerged. British authorities recognized the brewery as essential infrastructure and encouraged production to resume in August of 1900. Despite disrupted supply lines and ongoing conflict, the brewery returned to full capacity within just 1 year. This resilience would become SAB's defining characteristic, the ability to thrive in challenging conditions where rivals struggle and fail. The end of the Boer War brought severe economic depression to the region, but the brewing industry proved remarkably resistant to the downturn. While other businesses fought to survive, SAB began an aggressive expansion campaign across southern Africa, acquiring strategic assets that would cement its regional dominance, marking its first major international expansion. But SAB wasn't content with just acquiring existing operations. The company began diversifying strategically, purchasing boarding houses, investing in the Grand Hotel in Cape Town, and most notably, acquiring a substantial interest in the Schweppes company, marking its entry into the soft drink market. These seemingly random investments were calculated moves to control every aspect of the beverage supply chain. But as SAB grew stronger, larger challenges loomed on the horizon. By the 1950s, South Africa's apartheid system was becoming an international issue, and its effects on business were becoming impossible to ignore. In 1955, the South African government introduced discriminatory excise duties that specifically targeted beer, making it the most heavily taxed beverage in the country. And for the first time on record, beer consumption actually fell. Faced with critical decision, the company chose to fight back through consolidation. In 1956, SAB acquired its main rivals, Olson's Cape Breweries and United Breweries, in a move that united the 3 largest South African brewing companies. A masterstroke that gave SAB control of 90% of the domestic beer market, later growing to nearly 99%. The apartheid system created an unexpected problem. The government prevented companies like SAB from transferring capital out of South Africa. This forced the company to reinvest its surplus capital domestically, leading to massive diversification into non-core businesses, clothing retailers, furniture manufacturers, and discount department stores. By 1996, over 20% of SAB's workforce was employed in these non-core companies. Isolated from global markets, the brewery couldn't rely on imported raw materials. So, the company created its own supply chains from scratch, leading to some of its most innovative partnerships. SAB was essentially creating an entire agricultural ecosystem to support its operations. When World War I created severe bottle shortages, the company didn't wait for imports to resume. It established its own bottle-making plants. Every challenge became an opportunity to build greater self-sufficiency in the supply chain. The 1960s brought another unexpected opportunity. You see, from its inception until that point, South African breweries was largely restricted to selling to white consumers due to South Africa's racially discriminatory laws and liquor regulations. But when the government lifted the prohibition on liquor consumption by black South Africans, it opened a vast new market overnight. The majority of the population could now legally purchase its products, and the company provided a safer alternative to the dangerous moonshine. International brewers like Whitbread and Heineken attempted to enter the South African market during the 70s, but they couldn't compete with SAB's established distribution networks. By 1998, the brewery was considered one of the lowest-cost beer producers in the world. The company had developed an extensive distribution network augmented by a fleet of independent truck drivers, many of whom were former SAB employees who had received company assistance to start their own businesses. This created loyalty that went far beyond typical supplier relationships. By the late 90s, the transformation was complete. What had started as Charles Glass selling beer to miners in dusty Johannesburg had become an unstoppable force, controlling 99% of South Africa's entire beer market. The challenges that should have destroyed SAB had instead forged the company into a brewery that could thrive anywhere, under any conditions, and that would galvanize the South African brewer to go conquer the world. By the late 1980s, SAB had already saturated its home market and growth was stalling. At the same time, sweeping changes were reshaping the country. Apartheid was ending, and with it, the international sanctions that had isolated South African businesses for decades. In 1993, seizing the new freedom to invest abroad, SAB launched its first major wave of global expansion. But rather than head straight into mature markets, the company targeted developing economies, places where the institutional terrain resembled that of South Africa. In countries like Hungary and Poland, it applied its playbook: turn around struggling breweries, build local brands, and adapt quickly to unstable institutional environments. By 2001, these efforts were paying off. International operations already accounted for 42% of the company's turnover, and by now, SAB was already the world's third largest brewer. The company formed joint ventures where needed, but acquisitions were the core strategy. Romania, Slovakia, Russia, and the Czech Republic. In Asia, SAB entered China through a joint venture with China Resources Enterprise. This led to the birth of Snow Beer, which later became the world's top-selling beer by volume. Then, the company expanded into India and Vietnam. On the continent, SAB deepened its presence in Tanzania, Zambia, Angola, Uganda, and Mozambique. Local brews like Eagle Lager and cassava-based Impala were developed using regional ingredients to cut costs and support the supply chain of smallholder farmers. By the early 2000s, SAB had become the second largest brewer in China and was producing 2/3 of Africa's beer. It had built an empire, quietly, strategically, and largely in the world's toughest markets. But the stakes were about to get even higher. Despite its dominance in emerging markets, SAB lacked a foothold in the developed world, and investors started to become wary of companies too reliant on volatile regions. SAB needed diversification once again. And so, after months of negotiation, in July 2002, SAB acquired the Miller Brewing Company from Altria Group for more than $3 billion, along with $2 billion of assumed debt. This merger created SAB Miller plc, the world's second-largest brewer by volume. Miller, the second-largest brewer in the US, brought flagship brands like Miller Lite into the fold. SAB Miller immediately began restructuring Miller's struggling operations. shutting plants, replacing leadership, and refocusing the brand strategy. This deal did more than add revenue. It gave SAB Miller credibility, access to the world's largest beer market, and the marketing sophistication necessary to compete in developed economies. Following the acquisition, SAB Miller accelerated its global expansion: Italy, Colombia, and the Netherlands. By 2011, the company operated in over 75 countries, with more than 200 beer brands. Yet even as it grew, SAB Miller never lost its local touch. Only a few of its brands, like Peroni and Pilsner, were marketed globally. Most were tailored to local tastes and cultures, a strategy that positioned the company as the most local of the global brewers. From Johannesburg to Jakarta, from Warsaw to Wisconsin, SAB Miller grew by doing what others wouldn't. This strategy and operational excellence put the South African company on the radar of the world's largest brewer. On the continent, just a handful of beer companies are fighting for domination of the African brewing market. I did a whole episode on the real scramble for Africa when it comes to beer. But in 2015, the two largest brewers and fiercest competitors stood on top of their respective corners of the world with a single goal: create the first truly global beer company. And just like that, the stage was set for the largest merger in the history of the beer industry, one that would mark the final chapter in SAB Miller's extraordinary story. Anheuser-Busch InBev, already the world's largest brewer, had long set its sights on its closest rival. The strategic logic was clear. While AB InBev dominated in North America and parts of Europe, SAB Miller's strength laid in emerging markets: Africa, Latin America, and Asia. By combining these largely complementary footprints, AB InBev saw an opportunity to cement its dominance across every major beer-drinking region. Moreover, SAB Miller's success in challenging institutional environments made it a coveted target. The company had mastered the art of operating in markets with weak infrastructure, volatile currencies, and fragile regulatory systems. And for AB InBev, whose core investor 3G Capital favored aggressive expansion and cost-cutting, this experience was invaluable. The pursuit began quietly. Initial offers from AB InBev were rebuffed: £38, then £42 per share. SAB Miller's board believed the company was worth way more. Finally, AB InBev increased its offer to £44 per share, a nearly 50% premium on SAB Miller's market value, and the board accepted.
A massive takeover cleared its last big hurdle. SAB Miller shareholders overwhelmingly backed the more than $100 billion takeover by Anheuser-Busch InBev. Investors seemed happy, sending shares of AB InBev higher, and the merger between the world's biggest beer makers could usher in a new era for the industry.
Valued at more than $100 billion, the acquisition is the largest in beer history and one of the biggest mergers across all industries. By October 2016, the transaction was finalized. The structure of the deal is too complex for the scope of this episode, but to fund it, AB InBev lined up $70 billion in debt, and if the acquisition failed, the company agreed to pay a $3 billion break fee. And of course, the merger's size attracted scrutiny. Authorities across more than 30 jurisdictions demanded answers. Would this merger reduce competition? Would it raise prices for consumers? To satisfy regulators, a series of major divestments followed. SAB Miller, once the pride of Johannesburg, ceased to exist as an independent entity. Its stock stopped trading, its name was retired from corporate use, and its leadership dissolved. The acquisition was the end of SAB Miller, but not the end of its impact. To me, above all, the South African company proves that an entity born on the continent can rise to challenge the biggest names in global business and win. What's your opinion on the history of South African brewery? Let me know in the comments. Thanks for watching.